You might have seen the headline by now. Ford, one of the leading global automakers, has announced that they'll be cutting 3,000 jobs to further focus on their electric vehicle aspirations. You might be wondering, why are they doing this? And ultimately, what does it mean for their electric vehicle transition as companies around the world continue to further enhance and double down their investments in the space? Today, we're going to discuss 3 reasons why and then talk about what it means for the future of Ford. I'd love to know your thoughts, so drop in a comment below as we go along. First and foremost, you might be wondering, what is the story itself? So Ford Motor Company announced 3,000 jobs they'd be cutting this week. The split would be 2,000 salaried workers and then 1,000 contract personnel, predominantly from the US, while other positions such as from Canada and in India would potentially be cut. It's worth noting that this focus will be to fund the $50 billion that they previously earmarked for the transition towards electric vehicles. Now, as we know, their Ford Chief Executive Jim Farley had previously stated that he believed they had too many people, but more importantly, not enough of the right people in the right spaces to help to enable this electric vehicle transition. Obviously, it's a slightly different skill set, moving from the internal combustion engine vehicles towards the electric vehicles, and they really want to focus on batteries and software and the digital software and connectivity components of that. And of course, Jim Farley, as well as the broader Ford team, have mapped out their strategy for Ford and how they want to transition into this electric vehicle opportunity up ahead. We know it's coming, we know it's arriving. We saw the Inflation Reduction Act get a lot of attention over this past period, a lot of onshoring of both the supply chains as well as manufacturing of electric vehicles is likely to come as a result of that in the US and the broader North American supply chains. So in terms of enabling the EV transition, why number one? To understand this, we've got to make sense of Ford's plans that they've announced previously. And what's really worth noting is the incremental increase that they've continued to grow with, but also the short time horizons between each of these changes, which speaks to the increased demand that we're seeing for electric vehicles around the world, and obviously the government investment to support that. So initially, Ford announced plans to invest $22 billion globally in EVs by the end of 2025. Then they increased that pledge to $30 billion. Then at the back end of last year, in September, they announced over $11 billion worth of funding for a factory in Tennessee and then 2 battery parks in Kentucky. So this already was significant, $30 billion worth. But then to try and catch up with Tesla, who really have been the pioneers in the space, Ford announced they'd be upping their investment in the EV space to $50 billion through to 2026. Now the breakdown of that is to increase their electric vehicle production from 600,000 up to 2 million cars produced to 2026. That will be around 1/3 of Ford's global volume, before rising to half of Ford's total global volume by 2030. Of course, Ford, like many other cars, have commitments to achieve carbon neutrality by 2050, and they want to be using 100% of local renewable electricity in all of their manufacturing operations by 2035. They've obviously got grand aspirations. They want to be part of this decarbonisation trend and clean energy trend, but obviously there's going to need to be significant investment and focus to be able to get there. Along with that, we know that we're in an inflationary environment. There's a lot of pressure on companies at the moment, not just from the raw materials. As you can see here, the average cost of raw materials such as cobalt, nickel, and obviously lithium itself is now around $8,000 per vehicle, just above that. However, this is over 140% increase just from the March 2020 lows. So that is a fairly significant uplift when we consider it. We've got the lithium price here included. As you know, $60,000, $70,000 per tonne for LCE was almost unheard of just a few kind of months ago, particularly years ago, but we've got there now, and it seems like there's significant pressures on supply chains, and no matter how fast we get that supply response, at the moment there's an insatiable demand to really soak that up at this current stage. But of course, it's not just the raw materials. We know it's materials all the way through supply chain with inflationary pressures, but also the labour shortage that we're seeing affecting many of the automotive manufacturers as well as other companies. The third one is margins. This is a Ripper chart here that's been circulated previously. I'm sure you might have seen it before. It's got automotive gross margins. It goes to the end of calendar year 2021. So obviously it doesn't have kind of the most recent 2 prints that we've seen. But as we know, Tesla as the pioneer, it's really leaps and bounds ahead in terms of gross margin. It was fairly consistently kind of above that 25% mark. We know that Tesla peaked at that 32.9% mark in Q1 2022. Obviously, inflationary pressures last quarter meant they were back around that 28% mark for gross margin for the automotive side. However, when you look at all of Or many of the other leading manufacturers, companies in the teens are doing well, but Ford obviously has the opportunity or wants to feed into the opportunity to play in higher margin kind of fields. Obviously, all of these discussion points are interconnected, they interplay from each other, and they're relatively intertwined. But ultimately, there's a focus on cutting down their costs, improving margins, and being able to really feed into this electric vehicle transition, because we're seeing it in the here and now, and the legacy and incumbent automotive manufacturers don't want to be left behind, as companies like Tesla really help to pioneer this transition. And so before we discuss this snippet from the email that went around surrounding the changes from Ford, if you haven't yet, make sure you've subscribed and turn your bell notifications on. Plenty of videos across the markets and the macroeconomic picture. We've got many across the EV battery supply chain as well, which we'll leave links to after this one. So the email stated that Ford have an opportunity to lead this exciting new era of connected and electric vehicles. Obviously, that's talking about the digital connectivity on the software side, as well as the electric vehicle side, that they really want to prioritize with investment. Making this transition means redeploying resources and addressing our cost structure, which is uncompetitive currently versus traditional and new competitors. So they've acknowledged that, they acknowledge the opportunity that's there, and they've also laid out the roadmap and the aspirations for how they want to get there. We know that's not only Ford. Automotive manufacturers around the world are really doubling down on this investment, and it's noteworthy to see how quickly they're continuing to upgrade their forecasts, upgrade their investment, and upgrade their targets. Many of the current EV manufacturers, the pure plays, are really helping to lead this charge. We're starting to see the government investment picking up pace as well. We talked about the Inflation Reduction Act, but in nations around the world, there's incentives, there's subsidies, they're trying to bring down the barriers to entry for consumers to get onto the electric vehicles. Obviously, as we see bigger charging infrastructures roll out as well, this is only going to encourage and incentivize this transition from here. It looks like the electric vehicle revolution is here to stay, and it's only just commencing. I'd love to know your thoughts. Drop in a comment below. Big thanks for joining us. Check out another video in the space, but for now, stay well and happy investing.